Welcome to another ESSSuper investment update. 2018 was a year of two halves. The first 6 months to June saw growth perform strongly, whilst the 6 months that followed saw higher volatility and negative returns. Equity markets fell as the US Federal Reserve increased interest rates, and China and other emerging markets struggled to maintain their economic growth momentum. Ongoing trade policy tensions between the US and China, weakness in the global price for oil, and softness in Australia's housing market all weighed negatively on accumulation plan returns. Share markets gave up much of their strong performance from the first half of 2018, whilst bonds generated low but positive returns that were commensurate with the low interest rate environment. Unlisted property delivered a strong return, boosted by strong demand from local and international investors. The Australian share market lost 1% over the year to November, and this masked a 6.2% fall in the month of October. While negative 6.2 is not an unusual return from shares, it does highlight the importance of having a well-diversified portfolio that includes investments in other asset classes and an investment time horizon that is sufficiently long to tolerate the bumps along the way. Despite losing almost 7% in October, the US share market generated standout performance over the year to November, with the S&P 500 generating 5.6% over the past year on the back of robust economic activity and Trump's corporate tax cuts. In the UK, ongoing uncertainty surrounding Brexit negotiations weighed on business and consumer confidence. House prices and the number of houses sold declined. Against this backdrop, the Bank of England maintained interest rates at 0.75%. Business surveys in Europe have been weakening all year, which was partly linked to a decline in European manufacturing exports to China. Despite slowing growth in some European economies, the European Central Bank ended its quantitative easing program, which was really designed to kickstart the economy after the global financial crisis of 2008. Looking forward over the year ahead, there is likely to be increased volatility in equity markets from tightening monetary policy. Economic activity, however, remains relatively robust and not at recessionary levels. Equity markets may respond positively in 2019 from Chinese stimulus, more clarity around Brexit discussions, and slower interest rate increases by the central banks. Domestically in Australia, economic growth remains relatively positive, with unemployment at a low of 5.1% and inflation below the bottom of the RBA's 2 to 3% target range. The Reserve Bank in Australia has kept interest rates on hold at 1.5%, which will be supportive to the economy and the local share market. Over the 1 year to November, the decline in equity markets has meant that most of our growth-exposed accumulation options have failed to reach their investment objective. However, longer-term performance remains strong. Our accumulation options remain well diversified and have downside protection built into their investment strategies. Members benefited from this downside protection when markets declined in the latter half of 2018, and our options significantly outperformed median peers in the super rating survey. It's important to remember that superannuation investing is primarily designed with a long-term time horizon, and switching between investment options based on short-term returns can materially impact long-term performance. ESSSuper will continue to manage the accumulation plan to deliver optimal retirement outcomes for our members. We look forward to presenting to you next time. Thank you for watching.